Welcome to my channel again. This is what you hear if you turn to any media outlet these days.
The stock market has just opened after the Dow's worst day in nearly 2 years. The index closing down 3.6%.
Hey, Carl, Druckenmiller offering some pretty dire predictions.
What's going on here is a realization that things are slowing down considerably, and we may very well be in a recession right now.
Surprising new numbers from the government today. The U.S. economy shrank in the first quarter of 2022. The nation's gross domestic product declined at an annual rate of 1.4%.
So the agenda for this video is to define recession, review Reaganomics, and learn some useful indicators used by the Federal Reserve to gauge overall economic activity. So what is recession? If you ask Siri, she will tell you recession is a period of a temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in two successive quarters. A recession can be defined as a sustained period of weak or negative growth in real GDP that is accompanied by a significant rise in the unemployment rate. But probably the best way to explain recession is using Ronald Reagan quote. Recession is when your neighbor loses his job. Depression is when you lose yours. Speaking of Ronald Reagan, let's review Reaganomics and the total meltdown that's defining the moment of the 1980s. On October 19, 1987, known as Black Monday, Dow Jones Industrial Average dropped 500 points or more than 20%. Up to this point in history, this was the largest percentage drop in a single day. The world braced itself for another Great Depression. And the financial system comes with a minute of a total meltdown. What causes the stock market to crash? One is heightening the hostility in the Persian Gulf, a fear of higher interest rates, a 5-year bull market without significant correction. Pretty much similar to what we are going through. There is a war in Ukraine and a higher interest rate, but the bull market is not there yet. The second reason, the crash was triggered by computer program driven trading models that followed by investor panic. And as you may know, some hedge fund company they use algo to trade. So there is some similarity between the 1987 crash and what we are going through right now. After this crash, the Federal Reserve and Stock Exchange intervened by installing a mechanism called circuit breakers. Circuit breakers designed to slow down future plunges and stop trading when stocks fall too far or too fast. What ended the 1987 stock market crash? Under the Louvre Accord, the G5 nations agreed to stabilize exchange rates. In the United States, the Federal Reserve tightened monetary policy to halt the downward pressure on the dollar in the second and the third quarters of 1987, leading up to the crash. GDP is one of the most indicators to measure countries' economic health. GDP is a function of C, I, G, and NX, where C represents private consumption expenditures by households and nonprofit organizations. I refers to investment and businesses expenditures. G refers to government spending, and NX refers to net export and import. During a recession, the economy struggles, people lose work, companies make fewer sales, and the country's overall economic output declines. Recessions generally occur when there is a widespread drop in spending. Governments usually respond to recession by adopting expansionary macroeconomic policies such as increasing money supply or increasing government spending and decreasing taxation. This expansionary policies is designed to increase in investment, promote economic growth, and decrease in the unemployment. The U.S. Conference Board's Present Situation Index year-over-year change turns negative by more than 15 points before a recession. The U.S. Conference Board leading economic indicator year-over-year change turned negative before a recession. The Composite Index of Leading Indicators, otherwise known as the Leading Economic Index (LEI), is an index published monthly by the Conference Board. It is used to predict the direction of the global economic movements in the future months. The Chicago Fed National Activity Index, CFNAI, is a monthly index designed to gauge overall economic activities and related inflationary pressure. When the CFNAI diffusion index drops below the value of negative zero point 0.3, then there is an increased probability of the beginning a recession. Usually, the signal happens in the 3 months of the recession. The CFNAI diffusion index signal tends to happen about 1 month before a related signal by the CFNAI MA3, the 3 months moving average, drops below the negative zero point 0.7 level. The CFNAI MA3 correctly identified the 7 recessions between March 1967 and August 2019, while triggering only 2 false alarms. Thank you for watching. Happy trading. Have a nice day.